With the Vice President Treasury, Indika Ranavira, Vice President SME Banking, Ishani Palliguru, Vice President Project Finance, KV Vinod, Vice President Corporate Banking, Zian Hamid, Vice President Retail Banking, Damita Silva, Assistant Vice President Digital Banking, and Shanka Bewatan, Assistant Vice President Strategy. We all are, of course, maintaining the distance as required so you can see only me, but if needed in the Q&A session, they will join me to cover whatever the questions that you may have. So I'll move on to the very quickly corporate profile. NDB now 41 years. We started operations in 79 as a development bank. Now we are the fourth largest listed commercial bank in the country. Credit rating of A+, positive, stable outlook from Fitch. We are having about 3,000 staff working with NDB and about another 150 with NDB group companies, 113 branches, and of course, it's a strong digital platform that we are serving our clients. And we are the only bank with financial services in various fields like the NDB Investment Bank, which is a leader on themselves, then the NDB Wealth Management, again, the leading wealth management company, NDB Securities, NDB Zephyr, and also our operations in Bangladesh. And also, we are quite happy that we are the only EDGE-certified corporate in Sri Lanka, highlighting our gender equality, maintaining the gender equality in the organization. And of course, we have won several awards, multiple awards, as mentioned, and then Best Domestic Bank for the second consecutive year from Asia Money, and also the Best Digital Bank by Global Finance. And I have listed the other awards. This is a very quick glance through some of the key shareholder milestones, how NDB has evolved from 1979. Of course, we acquired the commercial banking operations of ABN AMRO. And in 2005, NDB converted to a fully fledged commercial bank from a development bank heritage. So we are talking about 15 years history as a commercial bank. And in 2019, we crossed 500 billion asset base, and also we became the fourth largest listed bank in 2019. And since then, we are maintaining that space. And in 2020, September, we crossed another milestone, passing 600 billion in terms of our assets. This is a quick summary of, again, historical financial performance. I thought that better to highlight this before going on to the quarterly accounts. Now, if you look at the rapid growth that NDB had, it is from 2017 onwards over the last 3.5 to 4 years. And we have maintained an annual cumulative average growth rate of 19% in our total assets. And also the loan book at CAGR of 22%. And in terms of deposits, the highest in the industry, 25%. Now, these ratios talks about how the ROE, ROA, NIM, and cost-income ratio has performed over the years. So NDB is in red, then the industry average is in black. There again, you would note that the ROE-wise, we have performed slightly above the industry over the 5 years. However, in terms of net interest margin, compared to what we were in 2015, where our NIM was around 2.6, we have come a long way to meet the industry average of 3.5%. So that is quite a good story in terms of the margins, how we have worked hard on getting the margins. Another one of the best stories that we can talk about is the cost-income ratio. From a high of 49% in 2015, we have brought it down to, as of 2019, it is 39.9, when the industry cost-income ratio has gone up to 47. As of September this year, this has further improved to 35.9. So that's a quick summary of how 5 years we have performed. And this is on the other balance sheet ratios. The CASA ratio, this is that NDB had been working hard, as I mentioned, a young bank, 15 years as a commercial bank. So most of our branch operations started only, the branch expansion started only somewhere around 2015 onwards. But even with that, we have been maintaining a CASA ratio of, as at 2019 end, it is 19.9, but that also has improved tremendously during this year to 22%. NPL ratio, again, we have been managing along with the industry trend. So you would see this is the reflection of how the country's NPL ratio has moved over the last 5 years. And NDB either slightly below or in line with the industry average. And in terms of capital adequacy ratio, now this is where NDB is working because that's slightly below the total industry capital average, capital adequacy ratio, and that is what is addressed through a capital raising activity that we have planned for that we have already announced, raising 8 billion rights issue. So to match, actually bridge this gap, when you compare with the industry, our capital ratios have been always about 1.5 to 2% below the average. So that is something we are going to address through the rights issue that we have announced. Moving on to the operating environment, it's about the global outlook. Of course, we all are quite concerned about the developments in the COVID-related issues. Overall, these are the numbers that IMF have published as of October, the latest IMF numbers. So global growth projection is a negative 4.4% GDP growth rate, and also a global growth projection for 2021 is 5.4% positive. So at least we can have some hope, hopefully, with the discovery of a vaccine. But this also have been revised down compared to June 2020 forecast of 5.4%. And then thereafter, after the rebound in 2021, the baseline forecast for global economy is somewhere around 3.5% in the medium term. Of course, these growth rates are largely depend on the behavior of the pandemic, which is evolving as we all see, and then also the lockdown and the distancing measures the respective countries are taking. So we need to bear that in mind. Advanced economies will have about negative 5.8% for this year, and then 2021 3.9%. And emerging markets like us, negative 3.3%, and then next year 6%. Getting back to Sri Lanka, of course, the trade deficit has improved to 4.3 billion in September, mainly due to one is the contraction in imports and also the exports. However, the contraction in imports are much higher than the exports. So as a result, the trade deficit has come down to 4.3 billion. Worker remittances, actually, we had a nice story here where we had seen quite a positive growth trend in September, and actually post-COVID, 3 years prior 3-year average of worker remittances was roughly about $500 million a month. But in July, September, we have crossed 700 million. Couple of reasons that I think central bank is attributing. One is it's possible that all the worker remittances are now being routed through proper banking channels. Earlier, some of those would have been channeled through non-banking channels where we won't get the numbers. Other one can be some staff or some employees overseas may have come back, and with that their terminal benefits or others, which is temporary. But I think more likely the funding coming through proper channels would have also contributed, but it's good to see the numbers growing. Then also we had a year-on-year growth of exports as well. So that is something positive post-COVID. The year-on-year inflation is 4% for October, which has come down from 5.7 in January. Rupee, we have seen it stabilizing at 184, 185 range, and deposits and lending rates, of course, are at very low rates. Now, LR as at 6th of November was 5.96. Now, compared to that, in January, the AWPLR was 9.68. So roughly about 400 basis point reduction in AWPLR. Weighted average deposit rates also at 6.23 compared to 8.1 in January. Government yields, securities have come down, remain at very low level. 91 days or 3 months at 4.57 and 1 year at 4.96. Other thing that we have noted is that the credit to private sector has notably increased in September, about 178 billion. And then probably one contribution can be the 178 billion approved by Central Bank under Saubhagya loan scheme. There again, NDB took a leading role. I think we were the 4th largest in terms of approvals, 18 billion approvals using the Saubhagya loan scheme. The Central Bank forecast for this year is a negative growth of 1.7. However, ADB forecast is about negative 5.5. So it's a range between quite a high negative level versus the Central Bank numbers. The 2021 Central Bank forecast is 5% and ADB forecast 4.1%. Both are positive numbers. So that's something noteworthy to note. This is about the policy stance taken by the Central Bank since the COVID outbreak, or even prior to that, because with the change of policies, we were going on a more accommodative policy. So we have seen quite a big drop in policy rates. All in all, during the year, 250 basis point cut in policy rates at various instances starting from January, then March, again in May, 50 basis point, and again in July, 100 basis point. So now 250 basis point reduction. Plus statutory reserve requirement has come down drastically. Now it is at 2%, all-time low level. Then the interest rates also, there were certain regulatory caps that were introduced. So cards at 18%, then the temporary overdrafts, pre-arranged temporary overdrafts at 16%, then pawning facilities. Actually, there is the uptick of pawning facilities in the industry as well at 10%. And then penal interest rate on overdues. Earlier it was 4% cap, now it has reduced to 2%. Apart from that, to facilitate the customers affected by the COVID impact, there was a moratorium introduced in April, which ended in September. But however, given the second wave that has taken place, regulator has also advised banks to consider another 6 months moratorium for those who require that. So that is going to start from 1st of October. And also there's an extension given to the Saubhagya loans that was granted in July, August. The grace period has been extended by 3 years. However, the remaining tenor remains at 24 months. So these are some of the operating environment that we are working, and under that circumstances that NDB performed the first 9 months. So I'll move on to the NDB's performance. So these are the performance highlights. Year-on-year, quarter 3 2019 to quarter 3 2020. The operating income, we had 11% growth. And operating expenses, we have managed to cut it down by 2%. So that is through various measures in terms of digitalization, the work streams, process improvements, and wherever controllable cost, we have been quite good at managing the cost down. There'll be a slide later about that. Profit before tax has 2% year-on-year growth from 7.6 to 7.7 billion. Profit after tax had 34% growth from 3.4 billion to 4.9 billion. In terms of assets, we had 13% growth in the total assets from 530 billion to 600 billion as at September. Gross loans, we had 8% growth to 443 billion and 15% growth in deposits for up to 464. So I think first time, compared to all the previous years, we had an advance to deposit ratio of less than 100, and now it's hovering around 94%. So that's actually a nice comfortable position in terms of liquidity a bank can enjoy in a situation like this. In terms of efficiencies, you would see a cost-income ratio, a very good reduction from 40% in 2019 to 35.9. I think this is the best, or if not the best, I think one of the best in terms of cost-income ratio among the entire banking industry. NPL ratio, of course, it has gone up. This is in line with the industry average of about 5.4. Ours is 5.5%. Net interest margin, of course, slightly has dropped from 2019 end of 3.5 to 3.23, reflecting the low interest that is prevailing. However, we have still maintained a 3.2% NIM, despite having certain caps introduced on interest rates for certain products, as we discussed earlier. Return on assets, that has also declined, mainly due to the COVID impact, from 2% to 1.7%. However, we have managed to keep the return on equity around 3.3%. This slide is some more details about the income level. This is interest income or fund-based income. There again, first 3 months last year versus first 9 months last year versus first 9 months this year. There's a 4% growth in interest income. Interest expenses, there's a growth of 3%, mainly due to the growth in the deposit base. However, all in all, the net interest income, we had again 4% from 13 billion to 13.6 billion. So roughly about 600 million increase in interest income. This is actually mainly the NIMs. There was a decline in 30 basis point in third quarter versus last year, same period. You would see over the period how the AWPLR has come down. Then the NIM of the NDB had been maintained around between 3.3 to 3.2, despite the rates coming down. So that is, despite the market rates coming down, we have kept the NIM at a static level. This is on the fee-based income, on fund income. There again, a good story, 5% growth in net fee and commission income from 2.7 to 2.9 billion. The non-fund income base, that's where 72% growth from 1.7 to 2.9 billion. So total non-fund based income has grown by 31%, or in other words, about 1.4 billion for the 9 months. The breakup, mainly you would see that the fund-based income has gone up by from 73 to 76, and non-fund based from 27 to 24%. 24 to 27%. So you would see that our fee-based income had a bigger to the total income compared to fund-based income. So if you look at some details, the net gains from trading, we had 779 million increase. Then the net gain from the capital gains from the government securities also had about 1.2 billion coming in from there. and non-fund-based income to fund-based income, as I mentioned, has improved to 27%. So as a result, the total operating income was up by 11% to 19.5 billion. This is a slide on impairment charges. So of course, the elevated high risk after the COVID impact is reflected in the impairment charges. Almost 2 billion increase compared to 9 months 2019 versus 9 months 2020, or in other words, 68% increase in impairments. So total impairment charge for up to now is 4.8 billion. So of that, collective impairment is driven by naturally the growth in the loan book. We had 53 billion growth in the loan book year on year, and also the provisions at the individual level considering the elevated risk due to the stressed market conditions. So as I mentioned, the gross NPL ratio over the year from first half last year, 4.56 to 5.57. That is in line with the industry NPL ratios that have gone up. Moving on to the operating expenses, this is where we have a good story. Now, personal expenses, all in all, the operating expenses, we have 2% reduction from 7.153 billion to 7 billion, so almost 120 million reduction in a era where the cost is going up. We have been working hard to manage the costs in terms of controllable costs down. So now this is despite the HR-related personal expenses going up by 4% and the depreciation due to investments. But the best reduction is on the other operating expenses, 10% reduction from 3 billion to 2.7 billion. So that's roughly 300 million saving in terms of controllable costs. So this is thanks to one is the digital means that we have moved into, and also the efficiencies that we have brought in, and also controllable costs, very close scrutiny and managing that through various ways to avoid unnecessary costs. So that has helped us to save about roughly 300 million on that. So in a challenging time like this, I think focusing on internal controllable costs has helped us to manage the cost and then have it as one of the best cost income ratio, which is reflected in the graph below from 2016, how the cost income ratio has improved from a high level of 49% to 35.8%. This is on taxation. There again, VAT on financial services remain the same figure in terms of the ratio, but there is a 7% increase in VAT charge from 1.3 to 1.4. There were certain taxes, those were removed in 2020, the debt repayment levy and then NBT on financial services. So as a result, we saved roughly close to about 950 million. So that is reflected in total taxes, about 23% reduction in total taxes compared to last year, 9 months. So effective tax rate has come down from roughly 56% last year to 42%. This is in line with the industry tax rates as well. So all in all, the profit after tax, we had 34% growth from 3.3 billion to 3.4 billion. And profit attributable to the shareholders at the group level had 32% growth from 2.9 billion to 3.8 billion. Moving on to the balance sheet, again, this is an area we have been focusing a lot to get our balance sheet mix and loan mix all right. And then as a result, you would see quite a good growth rate in the total assets, 95 billion in terms of year-on quantum growth, or 19% year-on growth, year-to-date growth of 13%, or 71 billion quantum growth for the 9 months. At a time that is challenging, yes, that is, I would say that a good achievement whilst maintaining the credit underwriting standards. Our investments remains around 45%, 45 billion growth in that. Gross loan book had 34%, 34 billion growth, or in other words, 8% year-to-date growth. Compared to September last year versus September this year, that's about 53 billion growth, or 14% year-on-year growth. Total deposits, that's a good story to see. For the year-to-date, there's a 59 billion growth, or 15% growth year-to-date. Year-on-year, last September to this September, 90 billion growth, or 24% growth. Borrowings remains almost the same level, about 8 billion increase only. And the equity, of course, these are the retained profits, about 5 billion growth. So one good thing is that we have a very well diversified loan book, of strength that has helped us to preserve the loan quality, and the loan growth has come from all sectors of the business lines. In terms of currency composition, that also has improved. So now it is at local currency rupee 83% versus 17. So this is improved from about 80-20 in 2019. This has improved. So that also one of our strategic imperative to improve the currency mix, and that has actually taken place. Other important milestone is the CASA, current and savings base. So we crossed 100 billion current and savings base as of September, and we had 21 billion growth for the year alone, or 26% increase in the CASA base for 9 months. And then as a result, the CASA ratio also has improved from 19.9% in 2019 end to 22%. Apart from that, we raised debenture, Tier 2 debenture in September, 6.5 billion. But prior to that, we redeemed a 10 billion debenture in June 2020. So these are some of the financial highlights on the balance sheet. In terms of NDB overall group assets, bank asset is 600 billion, and group level total asset is 605 billion. And these are slides related to the capital. So our Tier 1 ratio remains higher than the minimum requirement of 6.5 at 9.21. Group level, it's 9.7. And then total capital ratio, whilst the minimum is 12%, we have 14.21, and at group level, it's 14.62. And liquidity coverage ratios are quite healthy at 138% level, and NSR and NSF ratio also much above the 90% at 108%. So bank is quite liquid and also quite stable in terms of managing the funding in a stress situation, which we have done over the, I think, one of the most difficult 9 months, I would say. But despite that, bank has steered quite well in managing the liquidity situation and also the overall portfolio quality. And we have also done our mandatory the debt moratoriums and all, and we have also announced the capital raising activities by announcing a rights issue of 8 billion. Now this is to ensure, as I mentioned, the capital ratios are further stabilized because we were below the industry average, so we want to get to the industry level. So that is why we have announced the capital the rights issue. And this is, I believe, the last slide before I move on to the COVID impact. So this is on share price. So as at the last end of the quarter, we closed the share at 89. So this is prior to the announcement of the rights issue. And rights issue had been announced at 75 rupees per share. So as a result, post rights issue announcement, the price has come down to around 75 level. Earnings per share is now 23 rupees 92 cents. There again a slight improvement from 23, so 90-cent improvement. ROE at 13.3, ROA at 1.7. Book value per share is 187 for the bank level. The group level book value has crossed 200 rupees for the first time. So this is, and as a result, the price to book value bank level is 47%. At that group level, I would say around 38 or 40%. So that's where there's a tremendous potential as a share where the price is, of course, when you look at the banking industry, the price to book value, we are on par with the industry. Again, it's hovering around 48% or between 45 to 48. So yeah, there. However, it's a tremendous value when you compare the upside potential that NDB has. This is, I thought, including couple of slides before we move on to the Q&A, how NDB has responded to the COVID-19 situation. So I think this is where our investments in the digital financial services have helped us. So we, during the first lockdown time, I think we deployed our mobile units to provide access to cash throughout the country. Actually, we used that. We had only one, but we put 2 more vehicles into operation. Then the branches were selected in localities based on the government authorities' instructions with maintaining highest health standards. And our bank to you, the branchless banking proposition, we took it and went to those doorstep customers who are unable to come out, especially the elderly customers, to support their requirements. So these are some important steps that we took during the first lockdown period. And these measures are continuing, making use of the digital platforms and especially the QR code and all. Then soon after the lockdown was over, we came up with financial assistance for the refinancing arrangements. So that's where we took the lead in dispersing almost 18 billion worth of funds under the COVID Saubhagya scheme. And then in terms of the moratorium, initially in April, May, about 40% of the bank book was given considered under moratorium. However, as of September, those exposures under moratorium has come down to around less than 30%. So that is again a reflection of, yes, initially we provided the moratorium, most customers came out from that, and now it is only 30% of the book. But there again, the performance is quite good. Those who are under moratorium in terms of servicing interest, capital, they have been performing so far good. Of course, this is prior to the announcement of a further extension, but I think we are comfortable that we should be able to manage the customers given the quality of the portfolio. Then also we came up with a very dedicated proposition which we call NDB Jayagamu Sri Lanka. This is to get the exporters, the badly needed exporters, up to the market, and also the innovators taking advantage of the current situation where digital and then trading platforms are more important to showcase their products. So we tied up with several service providers like the Daras of Alibaba Subsidiary to have a platform to display this product. Then Code 365 for the exporters to go and market their products in overseas market. Tied up with MERS, the largest shipping line, to support exporters in terms of their shipments. Then iLoan to provide last mile financing for the SME sector. And various ERP solutions so that we would know their stocks and data situation there. And that would help in terms of our credit assessment, but that would also help them to manage their cash flows, the working capital better. So like that, various measures we introduced. Then we also continued our effort in carrying the female customers through banking on women proposition, and then through the Aralia platform, and also the Wanita Bimana award scheme, again recognizing the female entrepreneurs and their efforts which we had 3 sessions so far in province-wise, but due to the lockdown situation, we have to curtail the other 5 sessions we have planned, but that would continue moment the things are eased up. So these are some COVID-related responses that NDB did, and I think with that, I leave it open for the Q&A session, and of course, my colleagues will also there to answer any of your questions. So now it's open for your questions. So there's a question, what is the current corporate SME retail mix and how does this compare to the beginning of the year? Also, if you take the last 6 months where we do say the growth has come from. I think this mix has improved in terms of shift more towards retail and SME slightly. However, the growth has come from all sectors. All the sectors have grown. But some of the SME-related, COVID-related exposure through Saubhagya loan scheme, and then the retail side where we had quite a good growth. In the last 3 months, the shift has moved towards more on the retail and SME side. Are there any other questions? So far we have received only one question. So for that we have given the answer. We welcome. So there is a question again on, probably Shanjay can answer. Pawning book has seen a considerable growth in the last quarter, although still small in relation to total book. What is the strategy there? I think one reason for the pawning growth is, of course, one side the gold prices have gone up. On the other side, the interest rates have come down. So naturally, there's a tendency to make use of pawning as a means of managing short-term funding requirements. So that's where we had seen, and I think even in the country also there's a substantial growth in the pawning assets, probably due to these reasons. Sanjay, you want to add anything?
Yeah, I think in terms of the quantum, we had about a 2 billion growth so far for the year. And that is also we see coming from the business segment, like for the investment, the bulk pawning, not really at very low levels, but for business requirement, they keep borrowing. And we also have the short-term loan, which is quite popular, and these are cycles, like with the harvest coming in, we also see the settlements. So that's where the pawning, in terms of strategy, I think yes, we are quite serious about that pawning segment, but it's very small quantum. If you take a percentage of the total assets that we have, it's a very small quantum that we have.
Okay, thanks. So there's another question on what is the impact from second moratorium proposed to the banking sector overall and NDB in specific. So I think the second moratorium was just announced starting from 1st of October, but that saw the customers who have requested that. I think unlike the previous moratorium where it was probably it's like mandated. Now here the option is given for the customers and also the banks to give that moratorium. And then the interest is accrued at the contracted rate. So the impact on day one impact compared to the previous moratorium won't be there. In terms of impact to the NDB, as I mentioned earlier, when we began the post-COVID first wave moratorium, about 40% of our book was under moratorium, which has improved to around 30% under moratorium. So it has reduced from 40 to 30%. And even that 30%, the performance level was quite good. Those customers who were under the moratorium were performing. So I think with the second moratorium being offered, we need to wait and see how many of them would avail this offer. We have received some requests from the retail side, but I think that when you're aware that, okay, still you have to accrue interest, I mean, some of those requests have basically customers have agreed, no, we'll continue the payments. So it's a education part as well from the bank side as well. Maybe moment a moratorium is announced, naturally most would try to come and take advantage, but I think when you get more details, some would stick to their payment. If they have the ability to repay, they would of course naturally stick to the repayment plan. So it's still early for us to comment about the second moratorium, but I'm sure that a lesser number of customers might take the moratorium compared to what it was. Other thing is that moratorium is to especially those areas who are impacted by the second wave. So it's not throughout the portfolio. So we need to consider all that when a moratorium is granted for the second time. Sanjay, probably this question to you. When you say business segments are these still retail clients who are using the pawning for income generation?
Yes, I think mainly it is the individuals who are where their main source of income is business. Now, if you look at, for an example, one is on the agriculture side. The other is, as you know, the vehicle buying and selling business is quite popular these days due to the restriction in imports on new vehicles. So that they actually on a short-term basis, they do borrow and then they make a profit and then settle. So it's I would say it's they keep churning and then so those are very short-term facilities that they take. That's what we have seen in terms of the volumes.
See, when the interest rate is mandated at 10%, naturally a smart person would use that as a funding arrangement. So if you have gold assets, I think that's one of the smarter way to borrow rather than paying something higher. There's a question, would the current 30% on moratorium automatically get rolled over into next new one? No. Answer is no. So it's based on customer request and also based on our own assessment. But the leeway is given for further moratorium fund from 1st of October. There's a question, has the impairment model adjusted for the COVID impact and what kind of data has been incorporated? I think the yes, COVID impact has been factored. I think the loss given default, the probability of defaults have been also adjusted as we move on. So it's too early, but of course the historical data won't reflect that. But we have taken a certain percentage of factor in the impairment model. Shrindra, you want to add?
Factor adjustments also, we have taken the latest central bank published data in arriving at the economic factor adjustment. So effectively, we have taken in a significant amount of impact.
Okay. So there's a question. NDB did 18 billion in Saubhagya loans, so probably Indika can answer. And hence there was a scheme in where central bank is subsidizing 5% while the bank can lend 4% using their own funds. Were the bank received those subsidies from the central bank?
It's due in December, so we have about 6 billion exposure to there. So hopefully by December we'll get the payment from CBSL. So I think too early to comment. We expect this in December.
But in terms of the Saubhagya funding,
We received yes.
whatever we have sent to the central bank, we have received it in terms of the refinancing.
Yeah.
So there are two things, subsidizing is one, refinancing the other one. So in terms of refinancing loans, we have received refinancing within 2 weeks or maximum 1 month time lag, but we have received that. Subsidizing is what Indika was referring to. There was about 6 billion granted. Those, of course, we had to wait till December for the subsidized interest to come in. There's a question, any significant changes to holding in SLDBS ISPs relative to June 2020? Niran, would you like to take that? Yes, there is a change.
Yeah, yes, there is a change because with the yields moving up, so the bank also took a decision to reclassify part of the available for sale portfolio to held to maturity portfolio. So that was done as of September 30th. But we do have a not a significant amount, but a reasonable amount in the AFS portfolio as well currently.
So Niran, there is a related question later on as well. You can come closer if you want to see that. So it's one is that if the bank took an impairment hit in first quarter or second quarter due to fixed rate in downgrade. Yes, that we took a hit in actually this quarter. Downgrade happened in this quarter. Did the bank took an impairment hit in third quarter in anticipation of downgrade from fixed rating, which might follow Moody's? I think
Yes.
so that's basically the hit I was referring to. How much was the total impairment provision for those ISP and SLBB holdings? I don't know whether these numbers are disclosed. Can we disclose out?
Can disclose. Approximately around 300 million we have net provisions.
Okay. I think anything else that you want to add, Niran?
That's for this quarter.
This for this quarter, but there might be another part coming in for the fourth quarter as well.
Yeah.
There's a question on the moratorium again. What would be the average extension you think banks can afford willing to give extended moratorium? Will it be full 6 months or less? Now this is even if there's no regulatory mandate moratorium, if a customer is in genuine difficulties, any bank would offer flexible payment terms. So that is for the interest of both the customer and the bank. We don't want to squeeze a customer and make them kill so that we won't have any customers. So this is sustainable banking. So whether there's a moratorium or not mandated, banks would naturally take that decision. But when it comes to a willful defaulter, yes, we would go straight after them. So I think the message would be clear. Wherever we have to help the client, genuine reason, certainly we will help them.
COVID identified segment of the portfolio we give across a 6 months grace period, even before announcing the COVID. So that's the bank stance, as you said. If the businesses are stressed, of course, we have to look at it positively.
So far, these are the questions that we have received. We got a couple of more. Okay, so Suendrini, probably the first one you can take. How does the change from the IMF forecast to central bank forecast for impairment calculations affect the banking sector impairment for the upcoming quarters? Or were most banks using central bank forecast instead of IMF anyway?
Okay, I think we had some discussions with the CA Sri Lanka, and it was agreed that banks consistently use the central bank published data. So I think even for the fourth quarter, when we finalize annual financials, the banks will be using the central bank mandated data.
And then that's another question. What was the movement being from stage 2 to stage 3 over September quarter? What percentage of loan book is in stage 3 at September, and what was this number in June?
Yeah. In June, the stage 3 composition was at 8.2%, and in September it was around 8.5%. So there is no much movement in the stage 3 portfolio.
Fees and commission rebounded much faster in third quarter, even surpassing first quarter numbers. What was the reason behind this, and is this sustainable? Any one-off fees that came? I think one reason is the digital financial services and then the fee related to that, which is quite sustainable. Other one is, of course, the fees were capped. You may recall that even check return charges were not allowed to be charged. So, I mean, in a quarter where these fees or even the cards, the over limit fees and all, so many card related fees were curtailed. But despite that, the fee income has grown. Thanks to one is the digital channels that we have used and deployed, and where there's about 400% growth in terms of volumes, 500% growth in terms of transactions. And then the rebound of the trade activities in September, the last quarter, though, all that have helped us to get our fee income up. Anything else? The moratorium-based new term loans, are they considered for growth in the gross loans, which was disclosed? Is this impaired under different classification and using separate LGDs and PDs? Moratorium-based new loans, new term loans, are they considered for growth? Now, there are no, of course, if it's an interest capitalized, then that would be taken to the balance sheet, but I think the balance sheet is anyway in the interest now. So I don't think that there's a growth due to moratorium related term loans. No. Is this impaired under different classification using separate LGDs and PDs? Again, no. Answer is it's the same LGD PDs that we apply. And the other question is, has there been an impact on foreign loan availability or any impact on trade with international banks after the credit rating downgrade? Probably Vinod can take this. Do you expect there to be an impact on them if Fitch and S&P also downgrade?
I think the answer would be no from the NDB side. I think for us, the foreign banks and the foreign funding has been the same before the downgrade as well. I think we are very close with our correspondent banking network, and we keep updating them about the market situation. So that's one reason that they have been also very positive about NDB. So the answer is for us, it's no change from before the downgrade as well.
Just another question. What is the bank's exposure to the import financing segment? Any expectation of a recovery early next year? So of course the trading is about quite a sizable portfolio, trading customers. So some are going through these current trading restrictions, import restrictions. But on the other side, there are customers who are export driven. There naturally the imports are allowed. So it's all depending on the government policy as well, at what time some of these restrictions to be relaxed. So till then, I think those customers are finding it challenging. So, but we also from our side, whatever way that we can restructure and support, we have been supporting them. Niran, there's a question. Hasn't the rating change affect swap cost at least? So no change on swap cost. Okay.
No, there is no impact or change to that.
So again, a question on the economic forecast, probably Surendran can take it. The question is, when booking at the economic factor adjustment, were the bank using central bank forecast or IMF World Bank forecast prior to the recent guidance? I think most banks have used the central bank forecast, and that has been the practice in the country. So, Surendra, you want to add?
Yeah, so actually we were using the central bank, and we had our internal model also, which was aligned to the central bank data. So we will continue to use the central bank data. I think most banks have used the central bank data previously as well.
So next question is, what is the projection for PAT growth and NPL in 2021? We do have some ambitious numbers, but I don't want to just say that those numbers, but I think the NPL, that is something we need to see how the COVID impact is going to continue with us. I think we need to live with this situation for some time, but within that framework, how these customers would get adjusted to the new norm and come out from that. So it's all very related to the COVID impact. But in terms of current portfolio, we are quite fairly comfortable, the ability and also the spread of this exposure to different sectors. We don't have key sectors which are impacted. For example, the tourism might take more time to come out, but I think our exposure to tourism is less than 3% of the total loan book. So like that diversified portfolio that we have, so I think we should be able to manage it, but it's all depend on how long that we have to live with this current situation and how we act towards that. So that's where now we came up with certain initiatives to promote the exporters, promote giving them the platform. So many customers of us have made use of that technology-driven platform to display their products. In the event, customers are unable to come to their showroom to see their products. We are given that platform so they can showcase, and there are customers who have basically widened their market horizons using that platform. So I think that's a role a bank should also play, helping these clients using our technological advantage, so that the customers also, it's a win-win for the bank and the customer. So I think if we can stick to those new innovative ways, the digital platform, I think together we can help these customers also to come out. There's a question on how much the liquidity position was increased with the new asset classes coming in as liquid assets with central bank guidelines. So any other number? Or Niran?
What we can say is actually with the ADR also improving, the bank is at a very strong liquidity position, and we are maintaining our statutory ratios also very well above the central bank guideline ratios, something like in the range of liquid asset ratio around 26% and liquidity coverage ratio above 150. So which are significantly above the regulatory ratios.
There's a question on with the second wave continuously impacting, did the bank tighten the lending? No, I don't think we tighten our lending underwriting standards, but I think there's a lesser demand as well. I think you need to bear that in mind. In a situation like this, naturally the investors, the customers also think several times before they come and borrow. So we need to ensure that, I think, be mindful of what is going around. We are not change our underwriting standards. However, the customers also are careful in terms of borrowing. So I think it's a mix of both that has resulted. The other question is, how has the bank business momentum been outside the Western Province? Do you sense that the recent localized lockdown within the Western Province also impact growth and interest in other areas also? We are from the bank, we are shifting to more on the economic management. I think, of course, we have seen the growth in the outside the Western Province as well. Indika, you want to comment? Indika handles the business bank and probably Sanjay The branch banking side can come.
On SME side, because Western Province is the main contributor to GDP, and there's impact, we can't say there's no impact, we see a slowdown. But some of the industries doing okay, but there's a impact as well. So we can't say no to this straight away. Because when you come to the businesses, Western Province play a big role and main contributes to GDP. But if you look at the exporter side, we see improvement, and as a bank, we are also supporting because that is the area we see, irrespective of the COVID as well as the lockdown situ, where the things are moving. On the retail side, Sanjay, you can comment.
Yeah, I think we see across the board there is demand, so we are not reliant only on the Western Province. Of course, as Indika said, the volume comes from that. But the way we are diversified with the products that we have in terms of lending, we are covering the entire country. So if you look at our breakdown of our portfolio, it's across many sectors. So that's the success factor.
As one more, what are the policy for impairment when it comes to Saubhagya scheme? Are those loans go to stage 1 level, and does those loans take a higher provisioning comparatively, even when having the corporate, not the corporate guarantee, it's a guarantee from the central bank? Of course, the guarantee is up to 50%. However, as a normal, I mean, to normal LGDs and PDs, like any other loan. So initial loan, naturally, it would be categorized under stage one. But based on the performance, that they will move into 2 or 3. So that is something similar to any other loan. Any fresh loan, that way we give, always it is in stage 1. Have you seen a growth in housing loan segment? What is the maximum period that bank can fix the rate? So Sanjay, Niran.
Yeah. Yes, there is a demand with the low interest rate scenario. There is a demand for housing loans, and also looking at fixed rates. So we generally give 5-year fix, but we also go for 10-year, of course, with a little bit of a higher rate. And also the floating rate is given. So it depends on the customer's appetite, and then we have products based on that.
And what is the plan for credit cards? There was a strong acquisition drive prior to COVID. Will this continue? Zian is here. Okay, come.
In terms of credit card, we continue to grow, but however, the spend seem to have come down because of the lockdown. However, the internet-based, where the card not present, internet-based spend is increasing exponentially. So the growth is literally normal compared to the previous periods, which is catching up from the internet transactions.
And in terms of acquisition, I think we will continue to have that momentum growing. We'll have seen that we have introduced a loyalty card recently with Royal College, and then similar loyalty cards are coming up. We are investing in our card systems, so the new system will be ready most likely in the first quarter. So with that, more benefits, more structuring benefits are coming up. So cards is one of the key product that we are focusing on. And then, of course, you'd have seen our QR code involvement. There again, our banking app is the only app which is a wallet as well as banking transaction wallet. Probably, Damita, you want to explain a bit more on QR code, because that's we have made quite a good headway there, and it's interoperable. Probably Damita can explain a bit on that.
Yes, I think as you mentioned, by increasing NeosPay, which we call as NeosPay, powered by NDB, that's the first banking app in Sri Lanka, which has the capability of the banking app and the wallet, because we have made arrangements to join with JustPay platform. The most significant change of this app is now it is available for Sri Lankans who are having account with any other bank. So NeosPay is now not only restricted to NDB customers, but even other customers can join within few seconds. It's a very seamless process where the customer doesn't need to visit the branch, or we don't need to visit a customer. And ability to make payments through QR is something that we are driving at the moment. So NeosPay supports all these functionalities. So I think it's a revolutionary app in the market powered by NDB.
I think those are the questions that we have received so far. I think that's one more. How has the asset quality been on the card portfolio over the last 6 months? Yeah, so quality remains same.
It remains.
Yeah, we have not seen any deterioration in, there again, I think our card base is quite shifted towards the upper segment and the middle segment. So we have not seen any major deterioration in terms of portfolio quality in the cards. So thank you for all those questions. I think we have covered all the questions. And thank you for paying attention to our webinar, which is the practice that we have been doing for many years, every quarter, soon after the results are published. Would like to thank the investment community for asking all these questions. We are quite open in sharing the numbers. By the way, our September numbers are all audited by Ernst & Young in terms of profit certification. So all those numbers have been audited. And thank you for the support. And then looking forward to the raising of the rights issue funds. I think that's the other key goal that we have. So ensure that will be successfully subscribed. So we are quite optimistic of the situation. We are quite, and as you can see, compared to the industry numbers, the bank has grown. So we would continue to maintain the same optimism in managing the situation. So with that, would like to thank all and conclude this webinar. Thank you very much.